Welcome back to Talk Tensors, the show that takes you on deep dives into the latest and greatest machine learning research.
That's right. We're all about uncovering those hidden gems in the world of AI, and today we've got a real humdinger.
Oh, I love it when you say humdinger. So what's caught your eye this time?
Well, a paper crossed my desk recently titled Developing Cryptocurrency Trading Strategy Based on Autoencoders GNN's Algorithms.
Okay, that's a mouthful. Even for us AI aficionados.
It is. But trust me, the core idea is super intriguing. They're essentially trying to predict price swings in cryptocurrency markets, specifically Bitcoin perpetual futures.
Bitcoin price prediction. Now that's a challenge. And with a title like that, it sounds like they're bringing out the big guns. Autoencoders, CNNs, GANs.
Oh my. They're not messing around, that's for sure. But before we dive into the technical nitty-gritty, let's take a step back. Why is this type of prediction so sought after in the first place? I mean, people have been trying to crack the code of financial markets for ages.
Right, it's like the holy grail of finance. Predict the market, make a fortune. But crypto is notoriously volatile. It's like trying to predict the path of a caffeinated squirrel.
Exactly. And that's what makes this research so fascinating. If they've truly found a way to predict those big price swings in Bitcoin, the potential rewards could be astronomical.
Okay, so high risk, high reward.
Yeah.
Got it. But where does this paper fit into the bigger picture of AI in financial forecasting? I mean, haven't people been using computers to predict the market for decades?
Oh, absolutely. Early attempts relied on statistical models, but they often struggled to capture the complexity of financial markets. It's like trying to model a hurricane using only wind speed data. You're missing a lot of crucial information.
So they needed something more powerful, something that could handle the chaos. Enter deep learning, right?
Precisely. Deep learning, with its ability to learn intricate patterns from massive data sets, revolutionized financial forecasting. Suddenly, we could analyze vast amounts of data and uncover hidden relationships that traditional models simply couldn't see.
Okay, so deep learning is the game changer. But this paper goes a step further. It's not just about using deep learning. It's about the specific combination of autoencoders, CNNs, and GANs, right?
You got it. Each component plays a distinct role in this elaborate prediction machine. It's like they've assembled an all-star team of AI algorithms.
Okay, I'm intrigued. Let's break down these roles. First up, we have autoencoders. What's their superpower?
Autoencoders are like intelligent filters. They clean up the noisy price data before analysis. Imagine trying to listen to a radio station with a ton of static. The autoencoder is like a noise-canceling headphone. It removes the distractions so we can focus on the signal.
Ah, so we're prepping the data for the main event. Then what? Enter the CNN, ready to play detective.
You got it. CNNs are known for their ability to find patterns in visual data. Think image recognition. But here they're applied to the cleaned up price data. Imagine them as financial detectives looking for clues, subtle hints in the price charts that might signal a future price surge or dip.
Okay, so we've got the cleanup true and the detective. But what about the Jan? It feels like the mysterious, almost mythical creature in this lineup.
And for good reason. GANs are fascinating because they learn in an adversarial way. It's like a constant tug-of-war between two networks, the generator and the discriminator.
Ooh, a little machine learning drama. Tell me more. What are they battling over?
Well, the generator is trying to create synthetic price data that looks as real as possible. And the discriminator's job is to spot the fake. It's like a master forger trying to create a perfect replica of a famous painting while the art expert is trying to expose the forgery.
So the generator's constantly trying to outsmart the discriminator, and in doing so, it learns how to create incredibly realistic price data.
Exactly. It's a brilliant way to train a model to understand the nuances of price movements. By trying to fool the discriminator, the generator becomes a master of mimicking real-world market behavior.
This is shaping up to be a truly fascinating deep dive. But before we get too deep into the model's architecture, let's
take a quick pause. Come back and we'll unpack how they actually use this complex system to create a trading strategy.
Sounds good. See you in a bit.
So before the break, we were talking about how this model uses a combo of autoencoders, CNNs, and GANs to try and predict those big price swings in Bitcoin.
Yeah, it's like they've built this super sophisticated crystal ball for the crypto market. Yeah. But how do they actually translate those predictions into a trading strategy?
Well, their strategy is surprisingly straightforward. It's basically a buy low, sell high approach. If the model predicts a high probability of a price surge, they buy Bitcoin. And when a downward trend is anticipated, they sell.
Okay, so simple in theory, but timing is everything in trading. How do they determine when to enter and exit trades? Do they have specific price targets in mind?
Not exactly. They use a fixed holding period of 10 time units, which translates to 50 minutes because their data is collected in 5-minute intervals.
So they're riding the wave for a set amount of time, regardless of those small price fluctuations. That makes sense. But what if the price starts moving against their prediction? Do they just hold on and hope for the best?
Not quite. They've got a safety net built in a stop-loss mechanism. If the price deviates too far from the predicted direction, they automatically close the position to limit potential losses.
Ah, a smart move. It's like a safety parachute for their trading strategy. So all this sounds great in theory, but how does it actually perform in the real world?
Well, they conducted extensive backtesting using historical Bitcoin price data from January 2019 to October 2024, and the results were pretty impressive.
Okay, spill the beans. Give us the numbers.
Starting with just $1, their strategy yielded a net value of over $1,370,000 by the end of the backtesting period.
Whoa, over $1 million from a single dollar?
Yeah.
That's some serious ROI.
It is. It translates to a compounded annual growth rate of about 120%. And the maximum drawdown they experienced was just 15%, which is pretty remarkable considering how volatile Bitcoin can be.
Okay, color me impressed. But before we all rush out to invest our life savings, we need to remember this is based on historical data, right?
Exactly. Backtesting can provide valuable insights, but it's not a foolproof predictor of future performance. The real world is full of surprises, and no model can account for every possible scenario.
Like those black swan events we always hear about, the unexpected market crashes, the unforeseen regulatory changes.
Precisely. The 2022 crypto crash is a prime example. Even the most sophisticated models couldn't have predicted such an unprecedented event. It's a stark reminder that risk is an inherent part of any financial market, especially one as dynamic as cryptocurrency.
So a healthy dose of skepticism is definitely warranted. But still, these results are pretty tantalizing. Over 60% accuracy in predicting those big price swings in Bitcoin. That's not something to sneeze at.
Agreed. It suggests that machine learning can be a powerful tool for navigating the complexities of financial markets. But it's crucial to remember that no model is perfect, and real-world performance can vary significantly from backtested results.
So don't quit your day jobs just yet. But it's clear that AI is making waves in the world of finance. And this paper offers a glimpse into the potential of these advanced techniques.
It does, and it also raises some intriguing questions about the future of financial forecasting. What if we could go beyond just predicting prices and delve into more nuanced aspects of the market, like sentiment analysis?
Oh, sentiment analysis. Now you're speaking my language. That's a perfect segue into our Novel Notions segment, where we explore those very possibilities. Sentiment analysis. It's like peeking into the collective mind of the crypto community, trying to gauge the emotional temperature of the market.
Exactly.
Yeah.
Fear, greed, excitement, uncertainty, all these emotions play a huge role in driving market trends.
Right. It's like they say, the market is driven by two emotions, fear and greed.
Exactly. And if we could somehow tap into those emotions, we could gain a whole new level of insight into how the market might behave.
But how do we measure something as intangible as sentiment? It's not like we can just stick a thermometer in the internet and get a reading.
Well, that's where the magic of natural language processing comes, in NLP for short. We can train AI models to analyze text and code and extract meaning and sentiment from it.
So we're talking about feeding the model a massive diet of news articles, social media posts, online forums, chat logs, even the comments and code repositories.
Precisely. The more data, the better. The model can start to identify patterns in language, keywords, phrases, even emojis that correlate with different sentiments.
So it's like teaching the AI to read the mood of the crypto crowd, to understand the difference between Bitcoin is going to the moon and this is the end of crypto as we know it.
Exactly. And by tracking these sentiment trends over time, we might be able to anticipate shifts in market momentum, maybe even predict those big price swings before they happen.
Now that's what I'm talking about. But why stop at sentiment analysis? What if we could take this a step further and try to predict the emergence of entirely new crypto trends?
Now you're thinking big. Imagine a model that could analyze not just price data and sentiment, but also technical developments in the crypto space. Code commits on GitHub, the chatter in developer forums, white papers, academic research. It could potentially identify early signals of innovation shifts in developer focus, even the emergence of entirely new use cases for blockchain technology.
Wow, that's like having a crystal ball for the future of crypto. We'll be
Yeah.
going beyond predicting the weather and trying to anticipate the formation of entirely new weather patterns.
It's a bold vision, but I think it's within the realm of possibility. As AI continues to advance, we'll be able to unlock insights into the crypto market that were previously unimaginable.
It's definitely an exciting area for future research. And it highlights the fact that even with impressive results like the ones we discussed earlier, we're still just scratching the surface of what AI can do in the realm of finance.
Absolutely. And it's a reminder that while we can strive to build ever more sophisticated models, we must also acknowledge the inherent uncertainty of markets. There will always be surprises events that defy prediction.
Well said. And on that note, I think we've reached the end of our deep dive into the world of cryptocurrency prediction. We explored a fascinating paper that proposed a novel approach using a powerful combination of autoencoders, CNNs, and GANs. We discussed the impressive backtesting results, but also emphasized the importance of cautious interpretation and the need for real-world validation.
We then ventured into the realm of novel notions, exploring the intriguing possibilities of using similar AI techniques to gauge market sentiment and even predict the emergence of new crypto trends. It's a testament to the power of AI and the boundless potential of this field.
It certainly is. And as always, we encourage you to check out the show notes for a link of the paper and delve deeper into the technical details. Thanks for joining us on this Talk Tensors Deep Dive, and until next time, keep those neurons firing.